This next segment, in fact, is all about paradigms changing. We're going to hear later about blockchain, the underlying technology to Bitcoin. We're going to hear about maker movement, 3D printing, and a myriad of other opportunities that face us that are literally changing the paradigms across industries. And one industry that is in the crosshairs of this change, of these changes, these paradigm shifts, is insurance. Certainly, as an industry itself, it is subject to significant change over the next couple of decades. But also, insurance as an industry is concerned with everyone's risk as we go through paradigm change. When paradigms shift, risk becomes more essential and perhaps harder to imagine, harder to predict, harder to prepare for. So it is the job of a company like Zurich Insurance to try and figure that out, and it's led by an individual like Mike Foley, whom I'm pleased to say is a Kellogg alumnus, so he's keeping the world safe for Kellogg. And we've asked Mike to come and share a bit about how risk is changing in an interconnected world. Mike Foley.
Rob, thanks very much.
Thanks so much, Mike.
So good afternoon, everyone. Thanks for the opportunity to speak with you today. Changing risk in an interconnected world. So the World Economic Forum every year publishes a report that Zurich helps to co-sponsor that asks a panel of experts to look forward on different time horizons. This is 18 months and 10 years. And look forward and say, what are the biggest risks that are facing us? And if you look here, in the next 18 months, involuntary migration, state collapse or crisis, interstate conflict, lots of political, high structural or underemployment, and then failure of national governance, right? If you look 10 years out, though, a completely different set of risks, right? Water crisis, failure of climate change, extreme weather events, food crisis, profound social instability. So 18 months versus 10 years, when we asked them to think in different horizons, massive differences on the list. By the way, cyber was on there a couple of years ago and is not on there now. It's fallen down lower on the risk profile. Take that same 18-month horizon. So let's push the 10 years away because that seems really far away. Let's take the 18-month horizon and look at today what gets ranked 1 through 5 and what a year ago got ranked 1 through 5, right? So now it's involuntary migration. Before it was interstate conflict, state collapse. Then it was high structural or unemployment. These things are moving around a lot. So I'm going to make it conceptual and take the words away. That's today on the left, right? 1, 2, 3, 4, 5. 3 of those risks are new. The first, second, and fifth. The third and fourth, a year ago, people thought were big, and they're dropping down. The other 3 have fallen off the top 5, and some have even fallen off the top 10. If you went back just a couple of years ago, cyber was blinking brightly at everyone, right? So the world is changing, the risks are changing. It's really challenging to think about how do you adapt and how do you react. But one thing we would say is a key is to be resilient, right? To actually think that no matter what the risks are, no one knows exactly what they'll be and when they'll hit. So, a real plea for resilience on the part of all of us and all the people and companies. Now, it gets really messy. Take those same risks and plot them and say, what's the interconnection between those risks, right? So, and none of them stand alone. And we can knit them together into themes like climate change and environmental degradation or urbanization. But what you really see when you look at the center of that chart is lots of risks and lots of interconnectivity, which makes it really hard to think about how to quantify them and how to be ready for them and prepare for them. So I want to tell a story based on basically 2 ships, right? So go back a couple hundred years ago, insurance started in a coffee shop, Lloyd's of London, right? And at the time, a ship captain would show up and say, I'm about to set sail. I'd like to buy some insurance. I can't take this risk on myself. By the way, insurance is a critical part of society because it actually lets people pool their risk and lay off enough risk that they're comfortable to make an economic bet, right? But back then, there were lots of risks and they were pretty complicated, but nowhere near as complicated as today. If it was a good captain, if it was a good ship, if it was a route that they had sailed before, you could, as an insurance company, try to think about how to quantify that and how to determine what you would charge for that risk that you're undertaking. Today, that ship is part of a complex web, and in some ways it's much safer, right? By the way, I'd rather sail on the ship on the right than the ship on the left. But in terms of the web of interconnected risk, it's much more complicated. And so we asked our best underwriters with decades of experience in underwriting risks. We underwrite commercial risks, by the way. Decades of experience. We called them in, the best underwriters, and we said, what do you look for when you're thinking about how to quantify a risk? And we did it for different product lines and different industries. And there was a pretty consistent theme that basically our best underwriters, 2/3 of the time, could pretty well say, these are the things that will drive the underlying risk. Things like, is it a new route? Is it a good captain? Is it a safe ship? 1/3 of the time, the things they were looking at either were uncorrelated or actually counter-correlated. So they thought it would actually make it a safe risk or a dangerous risk, but it did just the opposite, right? So only 2/3 of the time were they even able to come up with a pattern recognition that would say, these are the things that we have to worry about. And then, by the way, there's no chance that a single person can now quantify that risk, right? Given the complexity of the world, there's no way to say for a commercial account, we're going to charge you $986,000.12 for your workers' compensation insurance, and to think that as a person, an individual, I can get that right? So the world has become very complex. Individual pattern recognition is no longer sufficient. You need to augment that with computers and algorithms and statistics, and together those two things come up with much better results. Okay, but the world is still a risky place, right? So 4 of the most costly events have occurred over the past 15 years, and those are Hurricane Katrina, which is the most costly, the Tohoku earthquake and tsunami in Japan, 9/11, and then Hurricane Sandy. And so things are happening around us, big events. By the way, we're in Miami, which hasn't had a significant hurricane in a long time, but the Great Miami Hurricane of 1926, 100-year storm, coming up on 100 years, cost the city about $1.2 billion. It's estimated today that it would be more than $150 billion if that same size storm hit this area, right? And if you look at it, there's cranes all over Miami that are building and creating even more risk and more concentration of risk. So there's lots of risk all around us. And then I will talk about cyber. I'm not going to go deep on cyber today, because I think I'll describe later why that it's actually a new emerging risk and harder to talk about and quantify. But cyber's out there, and it's growing, and it's, the simplest way is to look at the number of data breaches and records stolen, and you can see that all over the news. There's other components of cyber that I get to around the physical component of cyber. It's moving away from data breaches to, we're a large insurer of contractors, and at one of our contractor sites, they have a drone that goes up and drives a truck around the site and does real work around the site with people working all around them, completely powered by the drone. It then goes back when the battery's getting low, and it recharges, and it goes back up, and it continues to do the excavation work, right? So think about if there was a cyber breach on that, right? Something that's completely controlled autonomously with a drone and driving a massive vehicle. So cyber is a real thing, but I'm not going to go very deep on it today. So I would assert, we would assert that the economic cost of risk is rising. That's because of a concentration of risk. It's because of an increase of wealth. It's because of the fact that risk is increasing in and of itself. Although I'm going to argue that there's forces at play here that are important for us to understand. So forces driving more risk are digitization, globalization, extreme weather events, political unrest. So I can go through the long list of those, right? And when I look at that, there's really, I want to break this risk component into 3 areas. One is insured risk, so people have made a decision to buy insurance and lay off that risk or pool that risk. Another component is insurable risk, but people haven't purchased insurance for a wide variety of reasons, but they haven't purchased insurance. And then there's also a component of the risk that isn't insurable. It's not quantifiable, or there's some component of the risk itself that has an adverse selection bias to it. And so it's not something that can be economically pooled and solved with insurance. But that risk curve, I would say, is increasing. Go back to the Thai floods of 2011. There was $10 billion of insured losses out of $45 billion of economic loss, right? So that's the difference in that curve between the insured loss and the total economic loss. All right, I want to tell you a story about 1913, an assembly line, and I'm going to try to bring risk down to a factory and make it small and simple and safe, right? Just a simple factory, and use workers' compensation insurance. So in 1913, there were 30 deaths per 100,000 workers and roughly 700,000 injuries per year, okay? So this was a scary place, right? Working in a factory was a scary job at that point in time in 1913. Then society kicked in, and we required workers' compensation insurance. In fact, Zurich came to the US in 1912 in part because we knew that there was going to be workers' compensation in the US, and there had been a similar type of insurance in Switzerland. And so we came to the US to work on workers' compensation insurance. So now, fast forward to today, and I'll tell you how we think about risk for workers' compensation. So this chart's a little complicated, so I'm going to explain it for just a minute. So the horizontal here is the initial expected loss based on the underlying characteristics of the industry and the company that's at work. So the further to the right it is, think of something that's a heavier type of manufacturing, and the further to the left, think of something that's a lighter type of manufacturing. So inherently riskier to the right and less risky to the left. Okay, the vertical up and down is Zurich applying predictive analytics and additional insights through big data to differentiate those risks. They all started on that 0% line, and then we brought them either up because they were riskier than the average company in that area, or down because they were less risky. And that's kind of messy, so I'm going to clean it up and break it into deciles. And so if you think of it as deciles of risk, the least risky is to the left, and we can actually charge 43% less than the average price for a company in that type of manufacturing industry, because there are things about that company. They have a better return to work program, or they have a safer assembly line. There's something that makes it inherently a more attractive risk. And all the way to the right, we would have to charge 44% higher than the average cost because it's inherently riskier than their peer groups, right? So compare those two. That's either a penalty or a benefit of 2.5 times on the price, right, of the expected loss from that activity. So that's a feedback loop that actually tells companies what they're doing, right? Now, as a result of that, come forward 100 years to 2014, 95% reduction in deaths per 100,000 people. And if you look at the long-term trend in injuries, it's way down, right? It's gone down to from 22 injuries per 100 workers down to 7 or so, right? And actually, I want to clean that up and talk about it a different way. 1970 to 2015. Take 1970 as a benchmark of 100% of expected injuries or dollars of loss. In 2015, that's 30. So it's dropped by 70% from 1917 to 2015. And we would assert that that's because the risk pools have gotten more granular. The insights have gotten deeper. So back in 1970, we knew some things about companies, about what drove loss, but nowhere near as much as we do today. It's much more granular. And when that happens, there's a feedback loop that comes out for companies. Basically, you understand the risk, you identify what drives the risk, you can quantify it, and now you actually have feedback that says, what do I want to do with this? This is a real economic exposure that I have. I can mitigate that. I can actually do things to reduce that cost. I can move from the 10th decile down to a lower decile by doing things and being a better actor in my factory and thinking about how to change my, my process. Or I can lay that risk off to insurance and pay a huge price, right? So with that feedback loop, things get better over time, right? Now I want to broaden this out and come out of a factory. And this is the downward pressure on those insights. So understanding quantification leads to behavior modification. So risks come down in that feedback loop, right? So I want to broaden this out and talk about the Ford F-150. I'm not sure who here fits the profile, but the Ford F-150 is the best-selling vehicle in the US for the last 35 years, right? I think the F-250 might have squeaked by it this year, but Ford is still saying the F-Series is the best-selling vehicle. But in particular, tuxedo black is the best-selling color, at least in the year that I'm talking about for the Ford F-150. So it's a big deal, right? This is a big-selling car. This is the best-selling paint. Now, go back to the Tohoku earthquake and tsunami, and these two are inextricably linked because what happened was the single pigment, it's a Zurich black pigment, that you need to make tuxedo black paint was only made at one plant in Japan. And so as a result of the tsunami, Ford had to discontinue the tuxedo black F-150 until that plant could get back up and running. So just to show the interconnectivity of the world and how it can affect real things that people deal with every day. So the top 3 causes of supply chain disruption: IT and telecom outage, cyber attack and data breach, and adverse weather. Probably not terribly surprising, right? But when you talk to experts, those are the top 3 things that they list. 72% of the companies that we surveyed had experienced at least one instance of a supply chain disruption. So this is a real thing. It happens all the time. It's a big deal, right? 35% of them couldn't analyze and explain why it happened. They just had empty factories, and they said, it didn't show up. We don't know what really caused it, right? So this is not as well quantified, and the feedback loop isn't working as well as workers' compensation. And in fact, only 28% of companies would say that they have full visibility into their supply chain, where most of the others would say they either have partial visibility or no visibility at all, okay? Think of your suppliers as tier 1, which is a direct supplier to you, and then tier 2 is a supplier to your supplier, and then tier 3, and you could go on to tier N, right? So 61% of supply chain outages occur with tier 1 suppliers, and then the rest occur further down the line. So let's go a little deeper on this for a second. Let's take a supplier. This is a luxury auto manufacturing company, and they need aluminum and copper and rubber and steel and titanium and some other things. But for titanium, they have a set of suppliers that they use, supplier 1 through 4. We've flagged as red the largest economic risk suppliers, so S1 and S2. If they go down, there's $160 million or $420 million of purchases at risk for this company, which has a risk on their ability to manufacture. So you look at that and you look at supplier number 2, there's flood risk, there's storm risk, there's political instability, there's cyber and data breaches. You can look through and say, I understand this supplier, am I comfortable with this risk, or do I want to get another supplier? Do I want to work with them to mitigate their risks? Or again, you can buy insurance. We like that. You can buy insurance. So let's now shift to a multi-tier supplier, right? So same example, right? But supplier 4, I left off the other chart and some of the other suppliers, right? So supplier 4 here is a tier 1 supplier, only $50 million. And so that's not a big economic risk. It's not a red flag. But it also supplies supplier 1 and 2, right? And so when we look at that together as a tier 1 and tier 2 supplier, we find that it's a much bigger risk, right? It has the flood and storm risk, but the big risk it has is this multiplicative effect on the supply chain. If supplier 4 goes down, you lose supplier 4 and supplier 1 and 2. And we can quantify that. And we can look and say, there's basically 2 weeks of inventory in the system, because we did a great job of slimming down inventory all across the manufacturing system for auto goods. And so if that supplier goes down, on average, it's estimated to take 26 weeks to come up. That means there's 24 weeks of lost production, which is $160 million of economic value to the manufacturer. Now that it's quantified, they can look at that and say, should I add another supplier? Can I deal with that risk? What can I do to mitigate it? But if you don't look through and see it, you're not aware of it at all, right? So by quantifying it, you can address it, and you can use that feedback loop. Okay, so I want to talk about a risk continuum from high to low cross-subsidy. So insurance and risk in general is essentially about there's a risk, and you either take it yourself or you pool the risk and share it with someone else, right? So if the risk is not well understood, everyone pools it together, and when a bad outcome happens, you share that economic loss, and then you basically recapitalize and move forward. That's the basic rule of any type of insurance. So if there's high cross-subsidy, there's low insight, right? As you move forward, you start to get some clusters of risk and a better differentiation and a better understanding of how risk can apply at a low, medium, or high level. And you can charge accordingly and get that feedback loop to work, right? And then as you go even further, you get to essentially a risk continuum that's much more differentiated and much more granular over time. So workers' compensation is on the far right of that risk curve. The F-150 and the supply chain challenge of multi-tier suppliers and understanding in an interconnected global world where that risk lies is in that center part. And cyber risk is at the very beginning of this, right? I would argue that if you get to data breaches or some of the small parts of cyber risk, it's moving to cross-subsidy, but cyber risk itself is not well understood and it's not well defined. And so it's interesting. It's a place where there's huge demand that people want insurance, but we're not sure how to quantify it and deliver it yet, right? But cyber's in the early days of our understanding. And so in this complex, interconnected world, I would say that the world is risky. It's always been risky. If you go back to Lloyd's of London and the coffee shop, or if you come forward to today with cyber and massive ships and GPS and the Internet of Things. But there's a continuum here, and there's a continuous learning process where there are things pushing the risks up, whether it's extreme weather events or it's globalization or interconnection between those risks. And there are things pushing it down that come through big data and insights and a feedback loop of how we can manage individual and collective risks over time. But with that, I would say that overall, everyone needs insurance. Thank you.
Thanks.
Mike, before you exit the stage, right at the very beginning, I sort of want to jump out of my seat and ask a question. You had the opening about various types of risk. Just a few years ago, here are the top 5 types of risk that people are paying attention to.
Yep.
Today, just a year or two later, the list has changed radically. To what extent is it that the risks have changed or people's perceptions of the risk because it's in the news? How do you decipher that?
It's hard to tell, right? These are, it's a panel of experts, they're economists, and so it shouldn't be that it's completely influenced by the media events of the day. But clearly, there has to be some recency bias in some sense of that as well, right? Because, so political unrest is up near the top now. It's not like political unrest hasn't been there. Right. So I think it's a mix of the two, but I would just say what it really highlights is how hard it is to quantify and anticipate the risks that are going to be coming down towards us.
Great. Thanks again, Mike.
Yep.
That was
Thanks,
great.
Rob. Thank you.
Yeah.